Good afternoon, everyone. Welcome to the Sky High Symposium-92, the webinar on carbon accounting and offsetting organized by the Sustainability Reporting Standards Board of the ICAI. I would like to welcome you all for this webinar, and I can assure that we have a very interesting session lined up today by our industry expert. So on this webinar, I would firstly like to introduce the topic and then our experts speaking about the topic. So firstly, we have carbon credits, also known as carbon offsets, are permits that allow the owner to emit a certain amount of carbon dioxide or other greenhouse gases. One credit permits the emission of a certain ton of carbon dioxide or the equivalent in greenhouse gases. When companies are obligated by law to reduce the greenhouse gas emissions, they are sometimes allowed to purchase these offsets in the compliance market. These regulations also allow the offsets to reduce emission outside the cap for qualifying projects that reduce the greenhouse gases. I would now like to introduce the speaker for today. We have Mr. Prakhar Gupta. Um, he is a senior sustainability professional and leads the ESG advisory practice for Incorp Global, a Singapore headquartered advisory and compliance firm. He is also a chartered accountant and an MBA from the Indian School of Business. He is an ICAI certified BRSR professional and a GRI certified professional. Prakhar is empaneled as a special invitee member on the SRSB of the ICI, and he's currently working with 80 plus listed companies on the ESG and sustainability parameters. Thank you so much, Prakhar, for being a part of this webinar, and over to you.
Thanks, Aman. Thanks for the quick introduction and also talking about the topic. Let me just quickly share the screen and request if you can confirm if my screen is visible. Also, my voice is loud and clear.
Yeah, the screen's visible.
Yeah, Prakhar, we can hear you.
Great. So, hi everyone, and welcome to today's topic on a very interesting topic, I would say, on carbon accounting credits, especially from moving, I mean, almost 360-degree from financials and moving to an area which is pretty new to especially accountants like us, all of us. I mean, an area wherein we believe that most of us believes that it is an area which requires some technical expertise, especially from an environment expert or an environment graduate. But we'll just try to scratch the surface today. It's a big topic in itself, and I mean, 2 hours is very limited in order to cover the whole spectrum of the carbon accounting credits. But I will try and give you the perfect handbook with respect to which will help you to navigate through this whole carbon piece and be it scope 1, 2, 3, and then how to calculate, how to evaluate, and so on. So before moving on, I mean, also Aman just now mentioned that carbon credits are booming and it's something which allows you to emit. But then first, let's understand few basics about the whole climate market. Let's first come on the topic, which is also a very debatable topic in itself, whether climate change is real or not. So I just it's a quick 2-minute video I will play, and then we'll continue the discussion.
Does your parent, grandparent, or political representative suffer from climate change denial disorder? CCDD is a rapidly spreading disease that World Health officials say, if left untreated, could destroy the entire planet.
There's nothing more relaxing than being out here in the water.
Hey, get out of the way! Climate change denial disorder is a rapidly spreading disease that attacks the neurons, making it impossible to comprehend basic words like world, melting, not good, science, and factual.
They say the temperatures are higher than normal these days. I think that's a bunch of new age hooey garbage. It's snowing right now. Who cares if I'm in Southern California?
I don't believe the ice caps are melting. I believe the polar bears are just getting fatter and weighing them down. Ever think of that, hippies?
I'm gonna wait till more horrible shit happens to our planet. And I'm a senator, so fortunately, I get to make those decisions for all of us. You're welcome.
So, I mean, a very, very interesting topic, and it's just showcasing the perspective of the world in terms of there are a lot of people in the world which believes that carbon credit is or the climate change is not real, but on the factual ground, and there are a lot of facts and research which is highly, I mean, showcasing that it's a real phenomenon and that it's going reverse, it's going negative to the whole world. And as we say, the Earth is one, and it is something which is deteriorating the whole future, whole sustainability of the survival. And there are a few facts, like for example, if you see this graph on the right, it says global temperature is on the rise, and it's constantly on the rise. It is also on the smoothing curve, which is after averaging. Still, we can see there's a whole rise which is constantly happening because of the global change in the temperature. Same with sea levels. I mean, constant the sea levels are rising across the globe. And is Indian markets are away from this? No, not. I mean, even in India, this it's a recent report which was published in 2023. I mean, December 23, which shows that almost for 7 months. I mean, it's the data for almost not 7, 9 months, Jan to September 23. It says that every day we had a adverse natural calamity in some part or the other in India. So, which is itself is a very, very, a situation wherein we are caught up and no one is non-impacted. Everyone is impacted today. And if you see even the map of the country, which is shown on the right hand side, it says that all the states and are equally impacted. I mean, there's some or the other impact which has happened in even in most of the part of the states, and even in terms of the different sort of natural calamities, even that variation is there. In certain parts of the country, we saw heavy floods, flash floods coming in certain part of the country. There were cold waves, heat waves which are going on. The lightning and storming which are happening in certain part of the place, and so on. And the impact is also huge. Almost 80,000 people lost their homes. Close to 3,000 people died during this year. 92,000 animals lost their life during this year, mainly dedicated towards the climate change. Now, what is the impact in terms of financial case? We see also this is a recent publication which was from RBI, which says that even, I mean, if this pace continues of climate change, there is a huge impact of GDP which India has to pay specifically. And if you see, we are largely far more impacted than the rest of the world itself. We are expecting a close to 10% reduction of GDP by 2050 if this growth continues and people don't take actions with respect to improving their footprints on the climate change. In terms of the risk, there are also risks which is showcased by the RBI circular in the map, which shows that there are a lot of large piece of the country is already being hit by the heat waves. And what it results is, and why it is showcasing a GDP reduction is mainly directly correlatable, right? If the heat strokes will increase, the working hours will reduce. Eventually, the people will take more leaves. The effectiveness of the working hours will go down, and there will be other calamities which will be there on the top, like flash floods, sea level rises. I mean, all the coastals, you see blue part, everywhere it is impacted by the sea level rises. All the mountain part is impacted by the flooding of the Himalayan glaciers. I mean, melting is happening across the globe, across the glacier chain, and there's no part of the country which is non-impacted currently. And that's the importance of climate changes as of now. What is the commitment towards the climate change India is currently? So India is currently already a signatory of Paris Climate Agreement. All of us knows this very well. Now we are reading this about reading this in the news constantly. That we are a signatory to the Paris Climate Agreement, and we have also agreed on certain climate change goals. Like, for example, there is a goal which is in place which says that by 2030, India will reduce the emission intensity by 30 to 35% as compared to 2005 levels. So we have agreed to a cap which is 2005, and from there we have said that we will reduce our intensity by 35% by 2030. We have also agreed on a 40% cumulative switch towards electricity. I mean, switch to a renewable power sources. And I will showcase you why this is very, very important step. Overall, global level renewable switching is a very important step in this whole journey. And lastly, in terms of carbon sink, we are also saying that we will build up carbon sinks, which means that we will absorb carbon across 3 billion tons of carbon. We will absorb by 2030, and we will build that up. And apart from this, there is already a net zero goal which government has taken, which is 2070. So we are saying that by 2070 we will be focusing towards a net zero profile of the country. So overall, country level, we will be emitting, we will be absorbing more carbon than we are emitting the carbon. So that's the whole commitment which India has already taken. Now, why we are discussing this? Very important for all of us, interest for all of us, right? The first and foremost is, as I said, it's only one Earth. It's responsibility for all of us, not just corporate. We also share the responsibility in order to understand if there is a large amount of climate change happening, why it is happening, and how and in what shape and form we can do the appropriate accounting of carbon emissions, greenhouse gas emissions, and fix the responsibilities across the value chain. So that's one of the responsibilities there inbuilt in whatever we speak and do today, which is more of responsible citizen. Apart from this, I mean, there are some interesting areas. Like, for example, today, if you see any framework today, if any one of you is already into reporting style, I mean, we are working on reporting a lot of sustainability reports for the company, be it BRSR, GRIT, CFD, SSB. Everyone talks about carbon emission, carbon footprint as one of the calculation indicators, and there are other questions surrounding the same. So there is a need of carbon accounting a great time, and there are requirements of professionals in the industry which can effectively do the carbon accounting, understand how the carbon accounting is done. There is also a need of third-party assurance to come. So there is a need of professionals and set of professionals like capable of conducting third-party assurances of the calculations which have been, so that, I mean, sort of transparency and can be established on the numbers which are published by the corporates today. There is also a whole strategy piece which comes into picture, which is carbon reduction strategies on companies are working. So a big space opens up in those lines as well, wherein we can contribute, we can get on board with the companies and work on carbon reduction strategies with the companies. And there are two new areas again, which is carbon credit, which is an emerging market of carbon credit, which is coming in aggressively. I mean, across the globe, carbon credit is something which is being talked about now, which is again a new market, which is emerging. And then lastly, carbon taxation with CBAM, which is European EU Union's measure, which is carbon taxation. They've deployed. There's a new era of carbon taxation which has already been started across the globe. So carbon taxation again becomes an prominent area. We'll discuss all of these things in detail in my subsequent slide. So before I move on, I mean, first thing which I want to set it up for the for the remaining part of the session is that we have to extend our head. Currently, most of us are focusing on financial numbers. We have to now start focusing on carbon as one of the key parameters in our life, in our decision making, in our jobs, in our profiles. I mean, so it is something doable, and let's deep dive to do this. And these are the few things which I'm covering in the rest of my discussion, which is what is carbon footprint, what are the various categories of emission which exist, then what is carbon accounting, what do you mean by carbon accounting, what is the process and methodology of carbon accounting, how do you account for the carbon which is there in different bits and pieces, what do you mean by decarbonization, net zero. So once we have calculated the carbon, once we have identified our footprint, how do you reduce our footprint, what steps do you take, or what step an corporate take to reduce down the footprints of carbon, and in what shape and form. We will then move on to carbon offsetting. We'll discuss few concepts on what do you mean by carbon offsetting, carbon credits. And lastly, we'll end up with understanding a bit about carbon taxation. What do you mean by carbon taxation? What do you mean by CBAM, which is again a very hot topic today in the industry. So great. I mean, I hope everyone is with me till now, and we don't have any specific question. Ruchi and Aman.
We're all good. We're all good, Prakash.
Great. So let's
And
move on.
as a rule, we'll take all the questions at the end of the session.
Great. So you guys can put your questions on the chat, and then we will take up the questions at that. So moving on to the topic of the day, which is GHG footprint or carbon footprint. We understood the overall importance of climate change and the impact which is being caused due to climate change. One of the biggest factor of climate change is carbon or the greenhouse gas emission. Carbon is just one part of the greenhouse gas emission chain. There are other greenhouse gases which is emitted, but carbon takes the largest pie. So and we also see with few of the facts which are there, which I have covered in the slide. So it's a graph which is showing that, and it's a graph of last 8 lakh years till from the point today. It shows that how much carbon was there in the environment, and this whole data, which is before the industrial revolution, which is being captured, is captured through ice core data. So researchers constantly drill down the Antarctic and Arctic Ocean's ice, which have layers of ice, and then through that they are trying to understand how much carbon was there in the environment during different horizon of time. And if you see post-industrial revolution, what has happened is the carbon in the environment has kicked off drastically, which is this modern day period. If you can see this part, which is the modern day period, wherein the numbers right now is last year was 417 ppm, which is almost 2.5 times what it was there in the earlier times. And there are few, the specific reason is, as I even pointed out, the time wherein it has escalated, which is from industrial revolution. So human activities are the major causes of it, and mainly it is happening because of fossil fuels, right? So what was the major change which has happened in industrial revolution was we learned how to use fossil fuels effectively and in most of our operations, and hence due to that process the whole increase or rise of carbon emission has happened during that period, which is greenhouse gas emission, which has increased during that period. So the biggest factor in consideration is carbon, and that's where our focus is. We want to understand how do we calculate carbon footprint today. So what do you mean by carbon footprint? Now, in simpler terms, it is just calculating the footprint or calculating how much carbon as an individual a person is generating, or as an organization, the organization is generating. But it in order to structure it, you take it within a span of time. So you say that within a span of time, let's say a year, how much carbon dioxide the company has generated. And when you say carbon dioxide, it is equivalent carbon dioxide. When we say carbon dioxide, we consider 4 or 5 different gases, and in doing that conversion, we consolidate all the emissions into carbon form, and then the presentations happens in CO2 format, which is CO2e format, or carbon dioxide equivalent format, which is the scale which is used across this calculation. So the term which we have to consider here is carbon dioxide equivalent, which means not just carbon dioxide, but other gases like methane, CO4, and so on and so forth. So other gases are also being considered while considering the emission. Now, what these gases does is they get trapped into the atmosphere, and what they did is they increase the climate change, or the temperature rise happen at a faster pace. If more and more carbon gets trapped in the atmosphere, there is less amount of heat which gets reflected back, and most of the heat gets trapped back into the environment, and that's why the environmental or the temperature rise is happening on a constant basis. Now, which are the top emitters? Let's understand few profiles as well in terms of going forward, that which countries are the top emitter countries. To all of our surprise, if you see, India comes at the 3rd position right now. So India is the 3rd largest emitter of greenhouse gas emission across the world. And this is just the top 10 greenhouse gas emitter. And as a fact, today, more than 90% of the emission is happening by top 10 emitters of the world. So top 10 countries contributes to more than 90% of the greenhouse gas emission, mainly because of advancement, mainly because of production activities, agricultural activities, and also to yours. If you drill down it further in terms of sector, which sector contributes the more, you will be surprised to see electricity and heat across covers is the largest part, which takes the largest pie in the emission scale. So without any second thought, if you want to reduce down our emission footprint, we have to reduce down our electricity footprint. We have to ensure that how we can move from carbon-based electricity, fossil fuel-based electricity sources to non-fossil fuel-based electricity sources, and we can reduce a lot of amount of emission right on the. So that's where the target is with most of the countries today, and that's where you see a lot of adoption of renewables, a lot of adoption of alternative fuels, discussion of alternative fuels, which is happening today. Now, also an interesting fact which you see here in this graph is also agriculture is coming up. Now, why agriculture? I'm sure people would be figuring out the head, and transportation is also a separate category. So agriculture doesn't cover the transportation part of agriculture. Now, the biggest emitter in the agriculture space is for use of fertilizers. So today, pesticides and fertilizers which are used while growing the crops also contributes a very large amount of emission in the whole value chain. So there the concept of whole organic and reduction of use of fertilizers, pesticides and all is happening in order to ensure that the second bucket is also tapped out. So first is electricity and heat, and the second is agriculture. Now let's move on to the second graph of the space. And again, a very surprising revelation that most of the emission is done by the rich class, elite class of the society does the higher emission, which is also coming out from this graph. So if you see, per capita emission of US is way larger than India. We are very low on per capita emission, which is 2.46. But if US, you'll see it's more than 17-18%. The only thing is they are on the rising low reduction spree, and we are on the rising spree, mainly because of the growth period we are facing right now. We are in the as government said, Swarnim Kal. We are into the top, the best quartile or best 75 years of the country, wherein the country is seeing a very high growth and a very high growth pace, and we are expecting that will become the 3rd largest GDP very soon. So in terms of that pace, and that's why if you'll see constantly in the news that that struggle happens on coal, right? EU and Western countries are hitting India a lot on the usage of coal. asking us to take initiatives on reduction of coal, but India is still sticking towards, sort of sticking towards the coal, because then there is a need today. And there is not ample alternative available today to switch over. And if we currently switch over, then it will impact our growth speed as well. So that's where this fight is going on. And it's an interesting graph to show that although we are very low, but still we have been asked to do a lot of reductions in this space. So these are few interesting things which will set up the base for us. So few conclusions from this slide. First is we have to work on electricity a lot. We have to work on agriculture a lot overall, at least. First thing, electricity, we have to work a lot. And we are also being seen as the third largest contributor in terms of the emission space. So these are the two big things which we have to keep in mind while moving forward. Now, what are the different categories of emission? When we say emission, how do you define emission in a bit detail? So when I say, from this point on, I will interchangeably use words like emission, interchangeably will be used with carbon. So instead of carbon, I will say emission. Instead of emission, I can say carbon. Both are the same. So we have to consider both the terms as same. When I'm talking of emission, I'm talking of carbon emission at the base. So what kind of or what different types of emissions which are there? There are two broad categories of emission which you have to understand. First is direct emission. The second is indirect emission. Direct emission is something which is controlled, wherein the sources are with us. We control the sources. In terms of the overall emission, we know the source of emission is owned by the company or by the individual, and then it gets further divided into which is known as scope 1 emission, which is emission happening from your own sources. It gets further divided into stationary versus non-stationary emission. We'll discuss both of these terms in scope 1, 2, 3 also in detail in the subsequent slide. But then just to set up the context, stationary sources are the sources which are fixed sources like machinery, the process within the production plant, DG sets, for example, which are installed on the factory premises. These are all stationary sources. And non-stationary sources, as the name suggests, something which is movable like vehicles. So vehicles are known as non-stationary sources of emission. And these are direct sources of emission. For example, if you burn coal in the boiler today, so boiler is a stationary source, and boiler is owned by the company, which is hence you are causing a direct emission into the market, into the environment. And then indirect emission is mainly which is not in our control. Emission is happening at some other point, but you are consuming that resource, for example, and that it further divided into two categories, scope 2 and scope 3. Scope 2 is something which is emission while you purchase the electricity. Let's say I am purchasing the electricity from a grid, and there is an emission which is happening while generating that electricity. So that goes under the scope 2 emission. And then you have scope 3, which is ancillary emission, where I'm doing a lot of other activities during the business. Like, for example, I buy a laptop, I buy machineries, I take transportation services, my employee commute during the whole process. There are a lot of activities, ancillary activities, which has happened during the course of the business, which is in your value chain. The whole emission is considered under scope 3. So you have broadly, in order to conclude, you have direct emission, indirect emission as the base on the top, which is the high level categorization of the emission. Now going a bit detail into scope 1, 2, 3. And I will take some time on this slide. It's a very interesting slide to discuss and deliberate. Scope 1 mainly covers the emission, as I said, which is with your owned asset. And there are two broad categories of own asset, which is described in this graph. You see company's facility and company vehicle, which is in the red if you see in the reporting company is cycle. So when you say company's facility, it is the overall facility. Like, for example, as I said, your production process today requires boilers, heating process. And during the heating, you burn either, let's say, LPG, you burn PNG, you burn coal, you burn any other sources of fuel to generate that energy, to generate the heat, to generate the cooling, to generate the electricity. While you do this, you generate emission. So it's in your own, as I said, own premises, which constitute the emission. The other example could be your ACs. So we installed ACs like chillers in the premises, and there is a refrigerant which goes into the chiller. So it's again a type of fuel which emits when it leaks into the environment. It causes carbon emissions into the environment. So chillers and refrigerant gases also constitute part of company facilities, and emission happening through them is considered under scope 1 emission. And then company vehicles, which is the second category of stationary, non-stationary sources of emission, wherein you are putting diesel, let's say, in your SUVs, company-owned SUVs, company-owned vehicles, car, trucks, and forklifts, machinery. So whatever machineries, I mean, whatever vehicles which is owned by the company, and either petrol or diesel is consumed in the whole process of the chain, that emission is covered under the company vehicles category. Both these emission consolidated together comes under scope 1 category, which is also known as direct emission. So again, to repeat and to summarize, direct emission is emission coming out for fuel usage within your premises or outside your premises, but controlled by you. I mean, the machineries are controlled, owned by you through stationary and non-stationary sources of machinery. So non-stationary is vehicles, stationary is machineries which are set up within the premises. So this constitutes your scope 1 emission. Interestingly, if I have to combine this with your financials, what you can also check here and also make out from your financial today is whatever fuel and power cost which we are booking on ground, all that constitutes the emission profile. So in whatever shape and form we have bought fuels or energy or petrol, diesel, whatever name you give your and give to your financial GLs and books of accounts, I mean in the ledger, all that constitutes your scope 1 emission, and all that data or information is required to be extracted from those categories. It could be even reimbursements of fuels. So if you are doing a direct reimbursement of fuel, let's say to an employee or to a sales team, wherein they are presenting the bills and we are paying them back on the fuels, that also comes under scope 1 emission. So any direct impact the company is taking with respect to the fuel gets covered in the scope 1 emission. A simplistic way of looking towards the things. Now coming on to scope 2, which is the second category. Scope 2 is simple. I mean, whatever energy source we buy from outside, the energy, let's say in the form of electricity, the energy might be in the form of heat, the energy might be in the form of cooling. All the electricity, all the energy which we buy from outside, which is not generated by our own, comes under the scope 2 emission category, or the scope 2, and emission happening through these resources. Let's say from a grid which is generating, which is a coal-based grid, they are generating electricity, they are burning the coal, they are running the grid, and then from there the electricity is generated, and the electricity is transferred to a corporate or a company, and company is consuming the electricity. Now the amount of electricity and the emission emitted, the part of the electricity, for the extent of the part of the electricity, needs to be accounted by the company in their books as scope 2 emission, and the generator of the electricity, which is the company which is generating the electricity, they will account for it as a scope 1 emission. We'll understand this with an example and detail in the subsequent slide, mainly with electricity, because it's a very interesting category in itself. Coming on to the scope 3, which is an indirect emission category, which is the largest category among 1, 2, and 3, and which takes almost 70% of the emission of a company or footprint of a company, is covered in scope 3 category. Scope 3 is further divided into 15 subcategories and 2 broad headings: upstream activities and downstream activities. Just assume that you are covering the whole value chain of the company, which starts from buying the raw material, buying the capex, transportation of the capex and raw material to your factory premises, the whole waste which is generated during the process of manufacturing, the employee commute which is happening to your office, the business travel which the employees are doing during the whole process of the business which is happening. Let's say hotel stays, air travels, road travels, rail travels. Everything gets covered in the upstream category. So there are upstream categories, and then you have downstream categories. Downstream covers your final product transportation to, let's say, customer or to the distributor, and the value chain. Then processing of the sold product. So what will be the end of life of the product? So for example, if I'm generating a plastic container, what would be the end of life? How it will be disposed, and the emission at the time of disposal I have to account for while generating the product. Then franchises, I've given leased asset, I've leased the asset to someone else. So emission happening in those assets has to be. So on and all, there are 15 subcategories, and each category have a different set of activity which is covered, and for each of the categories the emission is calculated separately, and it's a very big intense calculation which happens. So and that's the reason mainly, if whosoever has dealt with BRSR as of now, in BRSR also, scope 1 and scope 2 is a mandatory category, mandatory response. And scope 3 is leadership because of the same reason, because it's very intensive on calculation. It's very difficult and intensive thing to calculate scope 3 emissions today. Now, a quick fact check. I mean, let me just run through these examples and take your views. I mean, Ruchi and Aman, you can give your views at least, and if others can just put in their chats, you can just translate their views. So We'll just go through which emission category is, what example it falls under which category. So for example, first one, which is boiler consuming a coal.
One, I guess. Scope 1?
It's one. You are attentive to the session. Great.
Good.
Electricity purchased from grid.
2. Second, Scope 2.
Great. Electricity generated. It's an interesting category. Electricity generated using own DigiSet.
1. Should be 1.
So it should be 1, and the emission which we have to account for is the diesel consumption and not the electricity generated. So what we have to consider is how much diesel we have consumed while generating the electricity and which has burned in the DigiSet. Then next is fuel reimbursements paid to employer. So a lot of companies have policy of fuel reimbursements, policy of paying direct reimbursements on bill. You collect the bill and you pay them back the amount which is mentioned in the bill, which is I have already disclosed, which is 1. So I'm just going forward. Then 5th is flight booking for employees.
That should be 3. No, sorry.
Right.
Yeah, that's 3. Okay.
Yeah, it's 3 because we are talking of an upstream activity where we are paying to a third party operator. So let's say airline is operated by a third party or railways is operated by a third party, and they are making the emission while doing the process, and we have to just account for our part of employees. Then renting of shuttle buses for employees office travel, again an interesting category.
I think same 3.
Yeah. So it can be 2 as well, but it also depends on who is paying for the fuel. So if the company is paying for the fuel, direct reimbursement of the fuel, again in this case. So for example, if the contract is that you get your bus, I will get the bus filled in with fuel and diesel and petrol, and then you just fly the bus. If this is the contract, then it goes in 1. But if the contract is just in terms of number of shifts or number of times the bus or shuttle will operate on a renting basis, then it depends under whose accounting this fuel cost is going. LPG used in office canteen.
2.
It's 1 because it's a direct fuel consumption. So you are consuming an LPG, which is a fuel in your office canteen. So it's a 1. 2 only covers mainly energy.
Can I ask a question here?
Sure.
So isn't the same logic of if the canteen is run by an external vendor and he's
same. Correct. It is the same, but again, so if he is getting usually what happens is you provide the LPG and canteen guy only have a catering contract there. He brings in all the fresh vegetables and foods and he cook and he serve. Usually that's the case in most of the company. That's why I've kept it 1. But you are right. It depends on who is booking the cost here. Then cooling gas filled in air conditioners. I think I have covered this while discussion, which is your scope 1. So the gas which you are refilling, which is R23, R32. Today's time it is mostly R32, which is having less footprint on the carbon. So whatever gas we are filling in the ACs, that needs to be accounted for. Then 9th is steam purchases from the third party. Now again, it is similar to electricity count, wherein you are buying. In other case, you are buying electricity from outside. In this case, you are buying steam sources from outside directly. So someone else is burning the coal. Someone else is boiling the water and generating the steam, and then that steam is directly passing on to us. Now, companies can play around in these cases. They can create a separate set of company and then pass it on these all activities into that company to reduce the direct footprint, but then still it is scope 2 category, so not very far from their books. Freight paid for raw material.
1. That's direct, right?
3, because you are not. You are paying the freight and not the cost of petrol and diesel here.
Okay.
That's why it is 3. If it's your own vehicles, then it goes in 1. Or other way around. Whoever is booking, as I said, whoever is booking the cost of. So the fact of the matter, the test which I'm trying to prove here is your financials directly showcases who has to book what. Even in scope 2, if the electricity is directly booked by you in your books of accounts, you have to cover that account for it. If it is booked by a lesser lessee, let's say a lesser lessee relationship is there, and you have rented a property and the electricity is borne by that person in that property, then he has to account for it. You don't have to account for it in scope, even in scope 2. But the other way around, if he's just paying your rent and then he has said that you pay whatever the expenses are, and then you are paying the electricity cost, then you have to account for it in the scope 2. So it's all depend on the accounting parameters, accounting boundary, and that's where our role is very important as a CS to determine where it will get booked and whether the bookings are correct or not. Hotel booking for employees, scope 3, I discussed very clearly. There's a category on travel in the upstream where you have to consider this. Now, again, very interesting case similar to DG said, wherein electricity is generated by coal in the coal power plant. So I have a own CPP in my premise and I'm generating the electricity out of it. It is not scope 2, it is scope 1 because I have to account for coal. I'm directly burning the coal and then generating the electricity. And I will not account for electricity because it is generated within my premise. So I guess it sets up a tone in terms of just making an understanding of what is scope 1, scope 2, scope 3 on an overall perspective. From this point, I will just slightly switch over to the next concept, which is how do we account for it? Now we have understand what it is all about. Let me just give me a minute. I think my battery is just. Yeah, sorry for the interruption. So the next part is we'll see how to account for it, which is how the overall accounting will happen from this point. Now we have understood there are different categories. We have understood the emission is important. We have understood that it contributes to the climate change as a whole. But now the most interesting thing starts, that how do you identify, how do you record, how do you measure the overall emission from on the footprint or your footprint. Now, to do that, there is a guideline which is widely accepted, which is known as GHG protocol or greenhouse gas protocol. Almost almost every company, almost 95% of the companies in the globe today use this protocol as a base protocol to account for and it sets out detailed guidelines on how do you account for the emission during the whole value chain. And they have covered detailed procedures for corporates, for countries as well. I mean, they have separate set of disclosures for country level, separate set of disclosures for corporate levels. They have gone into details of what sort of issues might happen, double counting, all that is in detail captured by this protocol. And they have released certain standards. So basically, GHG protocol provides is an agency, it's a non-profit organization, you can say in Indian terms, but then it's a global agency which is a partnership between World Resource Institute and the World Business Council of Sustainability Development. And it was established almost 20 years back, if I'm not wrong. And they have done a lot of homework on this front, and they have come up with a detailed set of standard guidelines, which is the first one. They also have training, they have tools, they have ample resources on their website. I've given the link of the website in the slides as well. And it has all the resources of the world to teach you, train you how the accounting and how the calculation happens in very, very detailed terms. They have published guidance, they have published standards. So the difference is mainly guidance is the precautions they have said, and they have also set standards, which is what are the rules of the land, how do you calculate, what things you should ensure before going into the whole space. And they have ample amount of trainings also available on their website. Now they have also published a corporate standard. There is a separate document which is known as corporate standard for calculation accounting of emission. The link also I have pasted here, which is the second link. This document is a detailed document, and it has given a lot of advice with respect to from where you will start, what would be the boundaries of emission, what would be the boundaries of organization. Some of the elements I've covered in my slide, which is relevant and which is important for the discussion. So the conclusion of the matter is this is one location point or one point which every one of us can refer to for all our solutions, all our answers of at least the basics of GHG protocol, GHG calculations or greenhouse gas calculations or emission calculations, whatever the name we use. The first thing which is common to all of us, understanding the principle of accounting. There are set principles even for GHG accounting. There are 5 broad principles which has to be followed every time when you conduct the GHG accounting. The first one is relevance. That what is the relevance? Why are you doing this? What is the relevance with respect to the organization in mind or individual in mind, whichever is the target set of audience? For whom are you doing the calculation? Are you doing for internal or external stakeholders, or you are doing it for what reason is being this calculation is being done? So first is setting the appropriate inventory boundary. And when you say inventory boundary, the word inventory here is the replacement of the word the carbon emitters or the sources of carbon emission. So what are the boundaries you have to set up? So what would be your organization boundary? What would be your operational boundary? I will discuss both of these terms in detail in the subsequent slide, but then you have to set up a boundary in the first case, which is What is your calculation boundary? The second is completeness. Once you do the boundary setting, the next is you have to ensure the material coverage. So it should not be that for one part you have done X, for the other company you have done Y. If you're doing a consolidated reporting, you have to do it from a completeness perspective. If you're following a rule, you have to follow it from a completeness perspective. You have to clearly state that what have you covered in the emission calculations and what have you not covered in the emission calculations. Like, for example, let's take the example of scope 3. It has, as I said, 15 categories. No company in the world today do all 15 categories reporting. So they do reporting of certain categories. While reporting, you should mention which categories are you reporting and what are the baselines you have considered for reporting, which is known as completeness. The next is consistency. As the name suggests, I mean, the data should be consistent enough. You should give time records of the data. So, example, more or less, you should always produce comparables of the data, and there has to be at least the trend presented of your emission. You should not give a standalone data of an emission, that what is the emission happened during the year. You should give a comparable, let's say 2-year, 3-year data of emission when you present back into the report. You should also detailed out estimates, and I will talk a lot more on the estimates in my coming slides, because there are a lot of assumptions we have to take during this whole set of calculation. The whole set of accounting, we have to take assumptions. What are those assumptions? You have to be very clearly state out those assumptions while you are reporting. So that is consistency. You follow what you are followed, and you also disclose what you are followed. Next is accuracy. Now, we should ensure that there are less amounts of errors which should happen. Again, the assumptions which you are taking should be scientific assumptions. It should not be random assumption out of the blue moon. You have assumed that there are 30 employees in your company. Let's say if you are accounting for employee commute, which is how much business travel, how much travel an employee is doing from home to office or to office to home, and you have just taken a number out of the thin air, which is, it doesn't have a scientific back. Usually what happens is you run a survey, you ask employees to submit their data, submit their information. Based on that, you take a number. So accuracy should be followed whenever you are doing this round of calculation, which is very important from a compliance perspective, from a reader perspective, from a stakeholder perspective. And lastly, transparency, which is you should validate and verify. So it's always good you should publish the number which is third party audited or third party validated, instead of just putting a self verified or self calculated number. So these are the 5 broad principles which are followed while using the GHG protocol or doing the accounting of GHG emission. Now, what is the process? And I will take a bit amount of time on this slide because it's again a very important slide from the concept perspective. What is the process of doing emission accounting? The process starts with first thing, which is setting the boundary, which is what is your reporting boundary. You want, even BRSR, if whoever has attempted the BRSR report or business responsibility and sustainability report, it asks the first question, which is in section A, which is, the question which is there in this, not the first question, but a question in section A states that what is the reporting boundary, whether you are reporting at the consolidated level or whether you are reporting at the standalone level. The reason is this report is going along with the annual report today, and then annual report has both set of reporting boundaries, and then user might get confused that what is your reporting boundary in which you are reporting. There are a lot of internal relationship which might exist. Like you are reporting for a holding company, and then it has subsidiaries, it has associates, it has JVs, and so on and so forth. It has franchisees. What all is covered in the reporting boundary? First thing you have to state. So what is your reporting boundary? And we'll discuss in detail how do you derive a reporting boundary in the subsequent slide. And next is operational boundary. When you say operational boundary, again, from a scope perspective, what all factors you are covering. Let's say within company A, you are covering scope 1, 2, 3. Then for all the other companies, you should also cover scope 1 and 2, 3, so that consistency remains, as we discussed in the principle. So what is your reporting boundary? What is your organizational boundary? And what is the operational boundary is first thing you have to set. So whenever you start the session with the company, first thing you have to ask is what is your current reporting boundary? What do you want to report or intend to report? The bare minimum reporting from an operational boundary is scope 1, scope 2. Most of the, all of the companies are expected to report scope 1 and scope 2. Scope 3 is optional in most of the cases, most of the reports, and it is a leadership indicator, which is considered good if you report that. So you have to discuss first what is your organizational boundary, what is your operational boundary, in order to start the whole process. In a bit detail, when you go in operational boundary, you will also check with the companies that what is the sources of emission, that what are you trying to cover. Let's say if the company is having a organizational boundary or let's say standalone entity. Within standalone, what are you covering? Are you covering all your plants? Are you covering your HOs as well? Are you covering all your real estate, which is let's say warehouses, let's say other categories of locations, like sales offices, all your what is the coverage of which goes and sits into the report has to be clearly defined before you start the job or start the process. So this is the first and foremost procedure which every one of us has to follow. Next is defining the base year. Now again, this can happen at the right start of the reporting year. It can happen at the later of the reporting year. You can continue reporting for a couple of years before coming up with a base year. What do you mean by base year? Base year is a year which is used as a comparable year. Let's say today I stand at 2024. I say this year is my base year, and whatever next set of comparables I will show, let's say 25, 26, 27, and the percentages I will show in respect to reduction of emission or increase of emission, I will stitch it back to the base year. So I will say my emission target is 25% reduction in next 5 years as compared to 2024, because 24 I have taken it as a base year. So what is your base year? You have to define a base year in order to showcase your transition. Otherwise, you'll keep on shifting. If you report it on a year-on-year basis, it becomes very difficult for the stakeholder to understand whether you are progressing in the positive or the negative direction, at least from an intensity perspective. Next is identification of emission sources. Now, the next step you'll do is you'll do a site visit, for example, or you'll do a virtual site visit with the company. And you take a tour of the site, you take the tour of the manufacturing site to identify what is the process of manufacturing, at which all points the fuel is being consumed, at what is the waste which is generated in the whole process, what are the sources of electricity from where the company is drawing, the site is drawing the electricity from, what sort of grid it is, whether it is also a renewable grid or a non-renewable grid from where the electricity is being generated, what sort of hazardous chemicals the company is doing, is there any effluent which is being excreted during the whole process. There are processes wherein chemical processes wherein carbon is emitted during the process. So if it is, let's say, some chemical is flowing through a pipe, there are leakages in the pipe, there are fumes which comes out during that process, and that also contributes to the carbon. So you have to understand the whole emission sources in the whole value chain, in the whole process, and then go on to the next process, which is selecting the approach of calculation. Now again, this we will discuss in detail in the subsequent slide, but then the idea is, what will be your approach? There are various approaches which are mentioned globally. Like, for example, GHG protocol is one of the approach. There might be other approaches also. There might be other calculation factors as well. Like you have to take assumptions, as I said. I will discuss again in the subsequent slides, which is the next point. How do you determine the emission factor? So usually what happens is when you do this sort of calculation, what you're trying to do is you're trying to identify the carbon constituent of the fuel. Let's say if I'm using a petrol, if you're filling a petrol on a fuel station, the constituent of carbon may vary from type of petrol you are buying or the company from which you are buying the petrol. The same might happen with diesel, the same might happen with other fuels. It might depend on the efficiency of the vehicle. It might depend on the efficiency of how old your vehicle is, how new your vehicle is. It might vary from case to case basis, which becomes a very complicated process. You don't know what is the carbon constituent in the process which you are doing. To simplify this, there are a lot of factors, globally adopted practices and globally adopted averages which have been published by several agencies like IPCC, like DEFRA in US also has a company which is known as US EPC. And they have come up with a lot of factors. They have published on their researches the factors which corporates and companies can directly adopt to and then use them as a conversion factor. I will just go again. This might sound alien as of now. We'll go in detail and you will understand a bit more when we go in the examples. Next is collection of the data. Once you have determined what is the source of emission, what is the factors you have to use, and what is the approach, you will start collecting the data. Now to do that as well, there are multiple approaches. Some companies use, some companies have IT systems in place that data is calculated directly on the IT system. Some companies do it on Excel. The biggest challenge which comes here is the consistency of unit of measurements. So for example, in certain cases, the same petrol or diesel might be measured in kiloliters terms, in certain cases in liter terms, in certain cases in gallon terms. And when you collate the data from multiple sources, there are chances of errors which can happen. You might consolidate something which is in different unit of measurement, and while consolidating, you didn't take it. You didn't take a factor into consideration, and your calculations will go haywire. So that's where, while collecting the data, it is very important to ensure that you are consolidating the correct unit of measurements. Then next is doing the emission calculation, which is once you start collecting, you have the factors, you do the calculation. You do the calculation at location level, or you might do the calculation at scope level. Let's say you are doing the calculation as consolidated scope 1, this is the number, scope 2, this is the number, and then you finally consolidate everything at the organization level. So when it is consolidated reporting, let's say there are 5 companies which are involved, you do the calculation at company level and then you consolidate everything back together. Now coming on to the very important aspect, first point, how do you define the organization boundaries? As I said, the reporting can happen at both the levels. You can report at standalone level and you can also report at consolidated level. Standalone is pretty simple. You only have one company to report, and whatever locations that company has, you can report. But when you go on the consolidated level, the issue starts popping out. That what is the level of consolidation you will use? For example, in financial also, when you consolidate it back, there are multiple ways in which you can consolidate. Same issue starts with the non-financial or the emission data as well. So there are multiple ways of consolidation. First is equity-based method, which is very clear. I mean, how much holding you have in terms of the economic interest. For example, in company A, you have 50% of the holding. Then that company calculates the emission. You take 50% of that emission in your books and you report, which is a clear method of equity-based methodology. The second approach is control-based approach, wherein the amount of control you have, on that basis you report. So although your economic control is 20%, but with that 20% you are controlling the board, the whole operation you are controlling, then you will report 100% emission of that entity. So these are the two different approaches you can select while defining your consolidation approach. Again, very interesting thing, even BRSR is pretty silent with respect to how do you consolidate the emissions. This protocol we can use, but as I said, in terms of ensuring the principles of reporting, we should write very clearly in the disclosures that we are using what method when we are doing the consolidation, whether you are using equity method or whether you are using control approach. In control approach also, there might be two variations: financial control, operational control. Financial control, and we are already chartered accountants, we understand this very well. And financial control is amount of control we have from a financial structure. Like say it's a subsidiary company, subsidiary holding relationship. So when it's a subsidiary holding relationship, we have a larger control on financial and other parameters of the company, and hence if we report with equity method, we will report only to the extent of economic interest. But if we report financial control, we'll report with 100% of that company within our consolidation. The next is operational control. Again, operational control is defined based on how much operative control we have. So we can take an example of classic step down subsidiary here, which is you have a step down subsidiary. We don't have a direct financial control in the subsidiary, but you have a via control. So you have an operational control established through your subsidiary into that subsidiary. So which means that you have a operational control in that case. And then again, based on if the operational control is 100%, you can take this also in the equity in the consolidation method while doing the consolidation of the same. Now let's understand this with an example. I have just put an example with 5 different cases which can happen. First is normal subsidiary group company relationship. So we have a subsidiary and then we want to consolidate. The first row, the first column rather, the third column and the fourth column gives equity method and the control method. So under equity method, we will only report to the extent of equity share we have in that company. So let's say if it's a 60% holding, we have a 60% interest in the company, it's a subsidiary and we have a 60% holding, we'll only report 60% of that company's emission. So that company has to consolidate, calculate, and we'll take the 60% piece and then report it back in our books. If it's an operational control, we'll report 100%, both from financial and operational. I mean, if it's a subsidiary company, we have both sort of control. In case of an associate or an affiliate company, we don't have a financial control. So if we have, let's say, 20%, 19%, 15% of the holding of that company, we will report only that 15% in an equity method. In an holding method or a control method, we will not report anything. It's a 0%. Assuming that we don't have any financial and operational control on that company. JV is an interesting case. Again, 50-50%. I mean, you have 50% control, 50% ownership. So in both the cases, you will follow the equity method of how much equity you own. Because in control also, that's the same. You control the company, or even the financial control of the company is equity based. So you will report the company based on the equity holding you have. Then investments, again, very interesting. You have investments, you have done investments in certain companies. Now, whether to report the investments or not, we don't need to report the investments from the consolidation strategy. But there is a category, if you have seen in scope 3, as an investment in the downstream categories. It says that you have to take care of the emission in the scope 3 bucket of the investment category. So you don't have to consolidate, but when you're doing scope 3 categorization, let's say for a bank for the matter, if you are a bank and you're doing a lot of investments across the board, and your money is going in creation of emission, let's say you are doing a company a company is doing, let's say, vehicle financing, and because of that financing, because they're investing in vehicles, there are a lot of emission which is being generated. That goes and sits in the scope 3 category for that company, and they should account for that as well. But to your surprise and to everyone's surprise, right now, at least in India, no bank is reporting the investment category, because it's a category which will sort of put a lot of pressure on the banks in terms of the disclosure. So right now, no one has adopted that category till now in India. The fifth is franchisees. It's again case-to-case method. If the franchisee is, they've just given a brand name to that person and they are owning everything on their own, we don't have to report anything. But if we have also given the whole space, we are also having equity control on the firm, we have the financial control on the firm, we have to report according to that nature. So that's the whole way in terms of the consolidation will happen, or the how do you define the organizational boundaries. Any Aman, Richa, anything to ask at this point? I'm sure it is getting technical, so I'm just taking a pause here.
Prakhar, you could go ahead.
Sorry.
Yeah, Ruchi, you can go ahead.
Yeah, no, I was just saying, Prakhar, that we'll take questions at the end. We have some questions coming from participants, but I think we'll take it at the end as a normal process.
So, I mean, because it's a very detailed down process where we are going in, I just thought to take a pause here. Great. So, coming on to the next part of the story, which is setting up the operational boundary. Now we have set up the organizational boundaries. We have defined how do you define the structure of the company. The next step we'll do is we'll set the operational boundaries. Now, let's take an example. I've included an example here. There's a company, which is company X. This is the parent company that has full operation of ownership and financial control of operations on A and B, but only 30% non-operating interest and no financial control in operation C. Now, how do you set the organizational boundary? It is clear. We just read out. X would decide whether to account for GHG emission by equity share or financial control. If the choice is equity share, X would include A and B as well as 30% of the C's emission. If the approach chosen is financial control, X would count A and B's emission as relevant and subject to consolidation. Once this has been decided, the organizational control is set. Now, coming on to the operational boundary. Once the organizational boundary is set, the X then needs to decide on basis of its business goals, whether to account only for scope 1, 2, or also go in scope 3. Now, if he decides he has to go in scope 3, in all the 3 companies or all the 2 companies, wherever he is doing the consolidation, he should go for scope 3 across the board. It should not be that in one company he will go scope 1, 2, 3, other companies will go scope 2, some companies will go scope 1. So very clearly, when you are defining the operational boundary, it has to be first of all constant across the board. Whatever scope you are following, scope 1 or 2 alone or scope 3 together, you have to follow it consistently. Let's say I have just given operational boundary for a category of emission may vary from scope 1 to 3 based on the organizational boundary. So your operational boundary might also vary. So the thing which we were discussing, right, in the examples, let's say your subsidiary company is having a power plant and they are generating the power and they are supplying the power to you. Now, your organizational boundary will define your operational boundary in this case. So our organizational boundary is let's say consolidation method. Then you will report scope 1 overall, because that company is also your company now. I mean, it's in your operational boundary or organizational boundary now. Sorry for that. Which is the fuel which is consumed by that organization will also get reported in your scope 1. Now, just take the reverse example. You are only doing the standalone reporting and you are not reporting at the consolidated level. Then this emission goes and sits in your scope 2. So that's where your organizational boundary will decide even your operational boundary subsequently. So it has to be very strategically decided, followed. You should first very specifically clear out what is your organizational boundary and then only go into the operational boundary. I hope I make sense what I said. I'll just repeat again. So if your subsidiary is owning a power plant and they are consuming coal to generate the power and you are buying the power, where you will report will depend on what sort of organizational boundary you are following. If it's a consolidation approach, all the emission will get reported in scope 1. If it is if it is a standalone based approach, you will only report scope 1 with respect to the holding company, and the electricity which you have bought in from your subsidiary will get reported in scope 2. So that's where your change of organizational boundary will impact your operational boundary. Very classic case, a very interesting case of electricity. I mean, electricity is something which we'll keep on discussing because, as I said at the starting also, it's the largest constituent of emission, and we should be very clear how the electricity at least is accounted for. Let's take an example. There is a generator which generates the electricity, and it emits one emission, which is 20 ton of emission. So scope 1, which is his case, it will be scope 1. He has burned the coal and he has generated the electricity, and he has emitted 20 tons of emission. Let me just use the pointer here. So he has generated 20 tons of emission here, and he supplied this electricity to a trader, which is just buying the electricity and selling. He has not consumed the electricity. So it's just an inventory for him. He bought in and sold. So his optional emission here is, because he has not done scope 1, he has not done scope 2 emission, he has not consumed the electricity. You have to only account for electricity. We have consumed it and bought it. Both conditions has to be covered while defining the emission. So for him, it is scope 3 emission, which is optional for him. If he wants to report, he can report 20 ton in scope 3, which is an optional category. Now, what he does is he sells this to a utility company. And during the utility process, usually you'll see in the transmit process, there is a loss of electricity which happens. So if 100 megawatt of electricity is going through the utility company or through transition distribution pipeline, there would be some amount of loss which will happen. In this case, they have assumed 5 megawatt of electricity is lost, and only 95 of megawatt of electricity is gone to end user. Now, for this company, which is for them, 1 ton, which is 5 megawatt equivalent electricity, equivalent emission, they will show in scope 2 category, because they are consuming the electricity within their premises, and while doing the transmitting, that electricity is lost, and they have consumed the electricity. And to the point of consumption, they will report scope 2 because they are not the generator of electricity. They are just buying and selling the electricity. And when it goes to the end user, he will report the whole 19 tons, which is 95 megawatt equivalent in his scope 2. And then in scope 3, will only report 1 ton. This company will report 19 ton in scope 3. So if you see the 20 ton, how it gets splitted in scope 1 and 2 and 3 in the whole value chain, in the whole process. And that's how this framework also ensures that there is no double accountability which happens. I will also discuss that in detail when I go further. And I'm sure there would be a lot of questions currently which is pointing in people's head that this might result in a lot of double accounting. But the whole structure is set in the tone that if everyone follows properly the mechanism, there would be no double accounting which will happen in the whole process, whole value chain. Next point, which is problem of double accounting. So how this mechanism is preventing double accounting? First is, if you follow clear guidelines of scope 1, 2, there would be no such case. Which will happen is one same category of emission will fall under same profile for 2 different companies. So it cannot happen that, let's say in this case itself, electricity generated by a company and consumed by another company, both will report electricity in scope 1, the emission coming from electricity in scope 1 category. One will report in scope 1, other will report in scope 2, the third might report in scope 3. Depending on the scenario, depending on the structure, the flow of the information, the flow of the final product which goes through. For example, as I said, scope 1 emission of company A, generator of electricity, can be counted as scope 2 emission of company B, which is end user of the electricity. So the hat will change, the category will change from scope 1 to scope 2. That's where the prevention will happen. So in scope 1 category, the double counting will not happen. In scope 2 category, the double counting will not happen. Similarly, the definition of scope 2 does not allow double counting of emission within scope 2, because there are 2 different companies cannot account same thing in scope 2. I mean, for both of these cases. Now, if you think this now let's expand this whole horizon. Let's see India as a whole doing a consolidation today instead of a company consolidating. Now, and what we have to also always do is start top down. So for India, we have to start top down, not bottom up. So you don't do summation of all scope 1s within the companies within the country, all scope 2s summation within the country. You have to start top down. You have to identify how much fuel India as a whole would have consumed in generation of, let's say, fuel, electricity, whatever power, whatever shape and form the fuel has been consumed. How much fuel during the year has been consumed at the India level, which goes in scope 1. Is there anything which is India buying from outside, let's say any electricity stream which we are buying from any neighboring country or any heating stream or any energy stream if we are buying from a neighboring country, which goes and sits in our scope 2 as a country's bucket. And whatever import, export, other ancillary services we are taking goes and sits in the scope 3 category as a country level. So automatically, once you define the organizational boundary, all of these confusion goes off. I mean, automatically your confusion goes off. Automatically, you will have a clarity on what will go in scope 2, what will go in scope 1, what will go in scope 3. And it will not be double counted ever. That's the beauty of the whole framework which they have designed, which is what GHG protocol has designed. Now, to this point, what we have concluded, I'll just summarize is that first, what is the process of doing the GHG accounting, which protocol to follow, what goes and sits in scope 1, 2, 3 categories, how do you set the operational boundaries, how do you set the organizational boundaries before going in, dwelling into the to the actual emission, I mean, identifying the emission stage. So from this stage, what we'll do is we'll identify where the emission is happening, the point of emission. So the point of emission, as I will go back to my previous slide when I was saying that you have stationary, non-stationary sources. This is the similar set of breakup. So what are the sources of emission today? What could be the possible sources of emission? This is just a bucket list. I mean, there could be more sources than this. It's just a broad list. So first is stationary combustion. So stationary combustion is combustion of fuel in stationary equipments like boiler, furnaces, burners, turbines, heaters, incinerators, engine flares, anything. I mean, wherever you are burning the fuel, all of that goes and sits in the stationary combustion space. Then you have mobile combustion, which is transportation mainly. So your automobiles, trucks, buses, forklifts, trains, I mean, aircrafts, whatever you have in terms of mobile combustion, all sits in the mobile category or mobile combustion category. So with the company, you should identify what are their stationary combustion sources, what are their mobile combustion sources. Third is process emissions. So during the process, is there emission which is happening? Like, for example, during the process of usage of the air conditioner, the gas leaks out, and that's the emission point. So during the process of something, is there any emission which is happening? Let's say any chemical process which is generating CO2 during the calcination, like cement factories, there's a calcination process which happens in cement manufacturing. That generates emission. That's a process emission. So third category we should check is process emission. Fourth is fugitive. Sorry, I wrongly covered the air condition example, process emission. It is a fugitive emission, which is intentionally or unintentionally any leakage of gases which has happened during the process, during the manufacturing process. Let's say there is a leakage in the joint. Very common, I mean, in case of oil and gas industry, there are leakages which has happened, spillages which happens during the whole course of transportation. Although it's a liquid fuel which gets leaked, so they cover that in the normal mobile consumption or stationary consumption because it's a fuel. But then fugitive emission is similar to that. During the process, there's some leakage or gas which has leaked during the whole process, and that needs to be accounted for. Next is office-based organizations. So now, interestingly, you have to also see the bifurcations from whatever we are discussing right now is related to manufacturing companies, right? What about service companies? Service companies don't have anything of this. Maximum, they will have mobile consumption. They might not have any stationary combustion. They might not have any process emissions. They might have fugitive emissions as well. So for an office organization, mainly the source of direct GHG emission is caused due to operation of vehicles or combustion device, refrigerator, air conditioners. But almost all businesses generate indirect emission, which is scope 2, which is electricity. So everywhere across the spectrum of companies, you will find scope 2 emission, which is there. I mean, the pace might vary. In case of service companies, there would be very little scope 1, but a lot of scope 2 emission. In case of manufacturing, you might have equal balancing of both scope 1, scope 2. There might be companies which run their whole factory on electricity, so you'll get very less scope 1 in that case. So depending on the nature of the business, depending on the type of industry, type of sector, your weightages might vary. But said and done, scope 3 is the largest weightage because you cover the whole value chain when you take the scope 3 category. So it accounts for the largest category, but it is still very complicated. That's why it has been kept optional for the companies as of now to be calculated. But several companies are already doing that calculation as we speak. Next is method to calculate emission. Now we have data in place, which is known as activity data. So what we have done is we have identified the source, we have identified what activity we have to capture. Let's say, for example, in case of going back to the same example, let's say in case of stationary combustion, we will take the purchase of fuel. We can also take the consumption of the fuel. It's up to you, but whatever you take, you have to justify and write down that what are you taking. Usually companies take purchase of the fuel. So how much fuel you have purchased during the whole process, you account for it. So that becomes the activity data. So for every purchase of fuel, that's the indicator or the activity you have to tap on and you get the data. For electricity, whatever electricity consumption which has happened in the invoices, whatever electricity count consumption is coming, you take that as activity data. So you identify the activity data for each of the category of emission. Once you have the activity data, let's say you know that now you have consumed during the year 500 megawatts of electricity. Then the next activity which you have to do is you have to identify the appropriate emission factor. I will come in the next slide. What do you mean by an emission factor and how do you identify it? But there are factors, as I said earlier, also there are several different factors which are published in the public domain today to help support this whole calculation. You have to identify which emission factor is the best suited factor for your calculation. And if I multiply both of these things together, you will get an emission. Let's say, for example, I have done 500 megawatts of used megawatts of electricity. My emission factor is 0.99 per megawatt. I will multiply 0.99 into 500 and you will get an answer of emission. Very simple calculation. Not simple as I am speaking. I mean, there might be some conversions during the whole process you might have to do. For example, from megawatt to kilowatt, you might have to convert because the factor is in kilowatt. So across, what you have to do is you have to ensure first thing is unit of measurements is in sync, because that creates a lot of errors. If in most of the companies reports today, you see, even BRSR, if you scan, I mean, especially the smaller spectrum of the companies, they have done errors on unit of measurements in when you're posting back the data. It's very complicated to convert back in the correct unit of measurements. Now, how do you approach the calculation? How do you identify the factors? What do you mean by factor? As I said, I already explained you in detail that it's very difficult to identify how much carbon constituent that fuel or that source of electricity has. In order to simplify this calculation, there are globally adopted practices which has come up with ratios or factors for which are standardized factors, which you can directly consume, read those documentations, find the most appropriate factor which is relevant for your use. That's the art. In terms of once you start doing it, you'll realize that there are some factors are updated 2 years back, some factors are recently updated. What I've also done is I've given you some references there. So these are different factors available online and mostly globally used across. IPCC today is most used conversion factor chain, then followed by US EPA because it is most updated. They update it every year. These factors are updated. You also have DEFRA. So these three are the most used. CA, which is an Indian organization, what they do is they publish a electricity emission factor every year in the country. Because right now India doesn't have a grid level data. The best scenario would be every grid should have an emission factor, because we know from which grid we are buying the electricity. We should have the electricity factor, which is there in US today. They have grid-wise electricity emission factor. We don't have a grid-wise emission factor. We have a country-wide emission factor today. So this CA is an organization which publishes the emission factor. What we have to do, as I said, take the emission factor, take the consumption, multiply the both, and you will get an emission. That calculation is usually happens. But then, as I said, the whole skill is to identify what is the correct emission factor. Now, the choice of factor might depend on sector, geography, emission source, as I said, and always the best suited benchmark rule or the thumb rule is you should go for a specific factor. If you have a specific factor available, don't go for a general factor. For example, let's going forward. Today, a lot of companies are capturing the value chain data. They have started capturing the value chain data. So I'm asking my vendor that what is the emission he is generating while in his book. So they are also, if you see in BRSR, there is an intensity which is being reported. That what is the emission intensity of a company at the turnover level. So for example, if my vendor is supplying me the intensity number, let's say he's saying that my intensity is per rupee, I generate 0.008 emission for generating 1 rupee revenue. And I know how much I'm paying to him. And that factor is the direct available factor for me to calculate the emission of that service of that product which I've taken. So we have to be very smart in terms of identifying that factor, and that has to be specific when we are doing that conversion. That's the whole crux of this whole matter. I mean, wherein your technical abilities matters, and you have to be a bit more research oriented to identify what is the best suited factor for a given set of variable or indicator. There might be a scenario that you are using some fuel category wherein there is no factor available. There are scenarios which we usually face while we work with several different companies. Then we have to even go on secondary research, find out is there any company individually which has published any relevant emission factor for that purpose or that nature. So the whole idea is to go to that appropriate factor, identify that factor, and multiply it to get the emission. Now, next is collection of the data. Again, some thoughts on it. First is, I would always say go for a site visit. So don't do the data collection virtually. If it's a manufacturing plant, at least go for, if there are multiple sites, try and attempt at least go for a couple of major sites they are having. It will give you a perspective of what is the production process, what are the different fuels the company is consuming, and what are their processes on ground. And it will help you a lot in terms of envisaging the scope 1, scope 2, scope 3 calculation. Now for scope 1, usually, as I said, you go for purchase quantity of the fuel type. For scope 2, you will get the electricity usage from the bills or invoices. The important thing here to notice, you should also understand that what is the source of electricity, from where that electricity is coming from. Is the electricity coming from renewable sources or from grids? There might be a scenario that there is a solar plant which is installed on the top of the facility, and they are consuming solar energy and not the grid energy. So in that case, the emission count, the factors, everything will vary. So that's why, I mean, you have to be intelligent enough to identify which source the electricity is coming from. And then scope 3 is very, as I said, it's very difficult to give you one answer on scope 3, but then it is activity based. Let's say if you are doing the calculation of fuel usage or passenger miles, you will rely on third party data. If you are doing calculations for employee commute, you will run surveys, run forms within the company to generate the data. So it depends on what category you are targeting. If it's, let's say, manufacturing category or the raw material category, you will take the emission from, if there is no specific emission available, there are emission available on quantum basis. So how much kg of let's say iron you have bought, how much kgs of cement you have bought, there are emission factors on that basis. So depending on what scope 3 category you are targeting, this is something which is very difficult to cover in a small scenario or small session. Now, how do you prepare a final emission report? So there are two basic approaches to prepare a final emission report or consolidation basis. One is centralized approach, other decentralized approach. It is just, I mean, namesake, they've just made two set of approaches. One is, when you do centralized approach, what you do is you collect all the data from sites on the core basis. That is, you do the calculations centrally, you only collect the base data from sites. So GHG emission is calculated at the corporate level. You calculate the activity data from the site. So for all the sites, you consolidate how much fuel is consumed in, let's say, vehicles, and how much petrol is consumed in the vehicle, running of the vehicle. How much diesel is consumed in running of, let's say, large, heavy machineries, heavy vehicles. How much diesel is consumed in DG set. And you consolidate all the data and you do calculations at the activity level, which is at the company level. The other option is you do these calculations on site basis. Let's say for site A, this is the scope 1 emission, this is the scope 2 emission, this is the scope 3 emission. And then you consolidate. The only risk here is, if you're doing this at the company level, your heads might vary. For something which you consolidate in scope 3, for you it might be scope 1 and vice versa. So that has to be accounted. Now, how does a report looks like? When you publish a GHG report, apart from reporting in the sustainability reports or in the BRSR or other reports, you can also publish this as a standalone basis. What you will do is you'll give a breakup first of all. What is the scope 1, scope 2, scope 3 emission of the company? You will also give intensity. You will also give ratios, comparisons with last year's. You will give a brief description of the emission sources. So you'll just describe what is the source, what is the justification of exclusion, inclusion, what have you left, what have you covered. You'll also give comparative information from previous year. What is the trend, how much it is growing, reducing. Then progress towards any targets. If the company has taken any target, let's say company has taken a target of 2050 net zero, what is the comparison with the base data and the target? So let's say target is 50% reduction. Where are you today? 20% reduction, 10% reduction, 30% reduction. And then list of assumptions. All the assumptions which you have taken in the last slides, from where you have taken the factor, from where you have taken the estimates, from where you have taken the conversion factors, you have to describe everything in the report. That's how you will prepare a report. Now coming on to the calculation piece, which is how do you do the sample. I just done a sample calculation for you just to show you that how a calculation, and this is a calculation of CO2 equivalent. As I said, there are other factors also which goes in one gas. It is not just CO2 alone. There are other gases also which goes CH4 and 2O. So it's an example of 1000 liter of diesel which is consumed in a DG set. What I've done is I've taken the fuel which is in gallons. Again, every time please ensure that you follow a unit of measurement. It is in gallons. And this is consolidated, which is 264 gallons of fuel. I think this is wrongly mentioned, it's on 1000 liters. This is 264 fuel which is being consumed. For 264 gallons of, sorry, it's converted from liters, it is converted to gallons, my bad. So 264 gallons of fuel which has been consumed. The emission factor is 10.21 per gallon. emission in tons, because this is ton CO2, is 2.70. So I'm converting from ton CO2 to, again, a conversion is happening from ton CO2 to gallon. So 2.70. So emission factor for CH4 similarly. Sorry, this is emission. So basically I multiplied 10.21 with 264 and I get 2.70. Then similar for CH4. So CH4, what is the emission factor? And what is the CH4 emission? And then the converted emission CO2 terms. So this is CH4 emission. This is converted emission in CO2. Similarly for N2, and then you have a consolidated emission. So this is a equivalent CO2 emission, which I discussed in the starting. So everything you convert into CO2 terms, and then you measure the emission and you report back in the reports. This is scope 1, for example, for a company. Just a slice of the scope 1 calculation. Just showing you a few reports. This is a report for EXA sustainability report, how they have presented their information. So you'll see number of group FTs from HR. So they have shown the comparables, how many FT or head counts they have, what is the internal area. So these numbers they have given for calculation of intensity. So what is the area they have occupied? Then they have shown emission. So total CO2 per person emission. This is intensity. So the total emission, which is this one, they have divided it by FT and they have come up with a per person emission. Similarly, they have given standalone emissions, individual. Scope 1, how much emission is there? Scope 2, how much emission is there? Scope 3, how much emission is there? They have also mentioned what type of emission on the top. Energy, car fleet, this is energy. They have given disclosures also, which includes what? Includes natural gas, biogas, heating oil. This one, when they say energy, they are saying energy coming from natural gas, biogas, heating oil. When this energy, which is D, they're saying, which is C, they're saying includes electricity, steam, and chilled water. So they're saying electricity purchased and the energy from that electricity, the emission from that part. And then scope 3, they have mentioned in E, which is business travel data has been collected from entities representing 96 this much business travel data. So they're saying which category they have targeted very clearly, what data they have included, what data they have not included. And then they are calculating. So business travel, how much emission is there? And then they have, what they've done is they have calculated the power consumption, total power consumption, fleet consumption, emission at fleet consumption level, emission at business travel level. So which is B plus C, and that's breakup of the calculation. And then they have also reported home, workplace, commute. All these are the breakups of scope 3 emission, what they have defined separately. And then home, workplace, commute per person. So they have given the data on that. Now they've also described the objectives. What were their objectives? They have taken certain targets, reduce energy consumption by some numbers. This was their target. This is where they stand. So by 2012 to 2020, they have taken a target. They're showcasing what was their target, where they stand, what is their performance, whether they've reached the target or not. So all of that they are showcasing. So they have the target of 35% reduction. They've done 50% reduction. And that's why saying we have reached the target. So for each of the target, they are showcasing a comparable number, a base year, which is 2012. And then the outputs of that target, and then performance also they are mentioning what is their overall performance of the emission. That's how the reporting happens back into the books. When you report, this is how you report. This is again a case of Shell. They are showcasing their emission, CO2, methane, N2O, H2O, different sort of emissions they are showcasing. What is their direct emission, which is scope 1, they are showcasing. And then what is the indirect emission, which is scope 2, they are showcasing that. And then other direct emissions, biogenic gas, CO2 transferred and all. And then they're describing the base year and the methodology of calculations. Again, just a glimpse of their report I have just presented for you in terms of, but this is a very detailed one. EXA was a very detailed case of how the mature reporting happens. Now this brings me to the end of my section of how do you do the calculation. Now we have all understood how to do the calculation, how to account for it. We have more 15 minutes, 20 minutes left. I mean, I leave 10 minutes for the Q&A. But let's just quickly understand how the decarbonization and offsetting happen from this point. Now we have done the calculation. We know what is the emission count. We know where we stand today. Now the whole objective is not to do the calculation. The objective is to reduce, right? That's where we started. We want to reduce. Now to reduce, what do you mean by decarbonization? The first question which comes is decarbonization. So decarbonization, just a quick video I will play for you all, which will give you the...
Wherever fossil energy sources are burned, man-made greenhouse gas emissions that are harmful to the climate are produced. This very problem is one of the major causes of climate change. The result? A global rise in temperatures and an increasing number of ever more severe extreme weather events. One important solution to combat this is decarbonization, meaning the replacement of fossil fuels with carbon-free renewable energy sources. This helps to reduce and avoid greenhouse gas emissions. The term decarbonization was made famous through the Paris Agreement in 2015. There, countless nations and businesses all over the world committed to taking short and long-term measures to significantly reduce their emissions by 2050. Yet, unfortunately, there is still far too great a divide between the current climate targets and planned implementation. For the decarbonization we urgently need, CO2 emissions must be reduced far more quickly and more drastically on all.
So this is what broadly decarbonization is meant by. You have identified the emission. Now the whole strategy to go down from that point is what we are discussing. And that's what the decarbonization strategy or decarbonization target is all about. How do you reduce down and create a positive impact from the point where you have done the calculation? So the first point is you do calculation. You understand where do you stand, and then you start reducing. Now to start reducing, you will then follow
levels.
The decarbonization route. Now there are some terminologies which I will just quickly cover here, which is how do you take a decarbonization route, right? So usually what happens is, like any other case, you start first of all with a baseline year. Let's say you'll say this is the year wherein I will have a maximum intensity of emission. So let's say you come up with a year, let's say 2025. You target that this is my year where I will tap the highest intensity of emission. From this point, I will fall down. I will go down. My intention is to go down from this year. So that year becomes your base year, which is a maximum emission intensity year or maximum emission year. The next step you will do is carbon reduction target. So you will take a reduction target, let's say in terms of within 3 years, within 5 years, you will take a target of X amount of reduction, 20% of reduction, 30% of reduction. That is the first step you take. You will take a reduction target, which is known as carbon reduction target. Then you will go on carbon neutrality. Now, there is a term which is known as carbon neutrality, which, as the name suggests, which means that on this point in time, you will become neutral. You will become carbon neutral. You will generate the carbon, X amount of carbon, and you will also absorb Y amount of carbon, which will be common, or which will the absorption will be more than the generation, basically. But the catch here is you can even do this even by adopting or doing your system changes. What you can also do is you can offset. You can buy credits from market, and still you can show carbon neutrality. That's where the catch is, and that's the difference between net zero versus carbon neutral. When you say net zero means you will not even emit the emission. Forget about absorbing the emission. What you want to do is you want to reduce down your footprint to that level that you will not emit the emission. I mean, you will use all your energy will be renewable, all your fleet will be EVs. Just think from an scenario perspective. And that's where the target companies have taken. Most of the companies have taken 2030, 2050, 2070. India has taken a target of 2070 net zero. The whole idea is to switch over as much as possible to renewables. And that's where the electricity piece comes into the picture. And that's why you'll understand why a lot of focus is there of government on renewables. Because if we only tackle the electricity today, you're already 80% of the work is done. I mean, 80% of your emission is coming from electricity. If I switch over electricity to renewables, I have already cleaned my value chain to a maximum level. Then only I have to see the ancillary emission which is being generated. Same applies for the companies. In the whole value chain, they have to ensure that the whole value chain is free from fossil generated electricity, fossil generated fuels which they are using. And that's where the net zero target. So that's the difference between carbon neutrality and net zero. And carbon neutrality and net zero are making a similar claim. But in carbon neutrality, you are generating the emission and then you are absorbing the emission. In net zero, you are not even generating the emission. You are just becoming zero by not generating the emission. Now, there are a few examples of net zero roadmap. There are companies like, for example, this is P&G's emission target. What they've done is they've started with 2010 as their path. That's the year which they've taken. 2021, they have shown their progress. They said they have taken some reduction target. Let's say reduce truck mileages by 25% of production. Reduce operation emission by 52%. This is the reduction targets that they've taken. Then they've given the acceleration path, wherein they've said they will go carbon neutral. So between 21 to 23, they said they will go carbon neutral. So you can see here, they will reduce the operation emission and they will ensure that everything is 100% renewable, which they are generating. On material, they are saying they will switch over to virgin petroleum, plastic, instead of, I mean, they will reduce virgin plastic, they will go for recycling, they will reduce supply chain emissions by 40%. And whatever is the balance, they will buy. or they will come up with the projects which will generate positive carbons for them. Let's say they will come up with a deforestation project. For Mumbai cuts, they might think of, or the people who are living in coastals, they might think of projects which is growing mangroves. So mangroves captures a lot of emission today. So such projects they will come up, which will give them an offset opportunity. So they can even buy it, they can have their own process in place and they can set it up. Then by 2040, they are saying net zero overall. So they're saying they'll switch over everything and they will ensure that balance any remaining emissions. They're saying cut most of our emission and balance any remaining emission that cannot be eliminated with natural or technical solutions that remove and store carbon. So they're saying only for the balance part, they will go for buying. So major part they've already covered, they've captured. That's what they're claiming. Similarly, India's net zero target, I already said, we have discussed this in the slides earlier. Now, there are 3 levels of strategy when you start doing the decarbonization process. There are 3 steps. First is you will improve the efficiency. So first is you'll do optimization, right? In general terminology, optimize, replace, offset. The first thing you'll do is you'll identify the opportunity to optimize first. Wherever optimizations are possible. For example, you'll conduct, if you are having an office space, you'll conduct an energy audit. With that audit, you'll identify what are the point of extra electricity you are consuming. You'll replace this with sensors, which common technique companies are doing. They replace with LEDs, they replace with other energy efficient devices, which means that they are doing an optimization of electricity usage. Where whatever they are using, they're optimizing. The next step is reduction. So first is you'll optimize. Whatever is left over, then you will reduce. You will try to reduce. When you do reduce, you'll do replace. So basically, you will replace your current grids with solar power plants. You'll replace your current fleet of transportations with EVs. You will replace your current fossil fuel driven burners or boilers with non-fossil fuel related boilers or burners like briquettes, like biofuels. You will switch over to that. So that is a reduction strategy, which is the next part. Last is offsetting. Now, offsetting is mainly investment categories that you invest somewhere else. You invest in carbon credit or you invest in a land. You build a solar power plant on the land. You are not consuming the solar on your own. You are passing the solar to the grid, but then you are getting a credit back for that electricity. But in the natural sense, you are buying the electricity still from a grid, which is generating the electricity from coal-based factor. Again, a quick fact check. I will just quickly wrap this up. The same example which I was telling. For example, company A installed a solar power plant on the factory's terrace, and the electricity generated from that solar power plant is sent back to the grid. So they are not consuming on their own. It's a negative metering which they have done. They're sending it back to the grid, and they are purchasing back the non-renewable energy from the grid. So they are getting the electricity back from the grid, but which is what is generated by the grid. So let's say they have they need a total 500 megawatt of electricity, out of which 240 megawatt is generated by their own solar energy plant. So how much you will report in scope 2 is what my question was. Right now, because they are doing a net negative and they're sending back this electricity to grid, they are not consuming it on their own. In scope 2, you will consider the complete 500 megawatt in scope 2. And then separately, as a separate line item, you show an offset and you will not reduce it directly from scope. But what if the case was other way around? The case is that you are reducing, you are consuming it and only net part you are drawing from the grid. So then only 260 megawatt will be shown in your scope 2 because 240 is already renewable, which is zero emission. So that's how you will, your offset versus reduction will play the whole game. So your optimization, reduction will have a direct impact on your count and offset will have an indirect impact. You separately show the offset when you do the accounting of the same. So there are a few examples which I've captured on optimization. So first is Mahindra. So Mahindra has, for example, taken energy efficiency initiative. They said that they will remove the conventional boilers with energy efficient electric boilers, in air handling units. They will change 200 old ACs with brushless direct current motors, which is a different technology which they have identified. So similarly, Tata Chemicals has also shown their optimization strategies in their books. So these are the examples of optimization which is happening, which is our first layer, first step. We'll first optimize. Then second is reduction, which is switching over, replacements. So renewable power, for example, in their case, they've also done a thermal energy fuel switch, wherein they're switching their current fuel which they're using with the thermal energy fuel switch. They're also making changes in their supply chain and logistics structures by going up with the larger packing size, reducing the way in which they ship the whole material. So all that changes they're doing on the supply chain logistics perspective, which can be a reduction strategy. Similarly, Mahindra has also adopted renewables. So they are saying that they have a net neutrality target by 2040. And for that, they have done some adoption of 58 megawatt captive solar power plant already. Now, the word is captive plant, which means that they are consuming this electricity on their own. They are self-consuming this electricity. So that's the reduction strategy. And last is offsetting. So they are saying that Mahindra, for example, they've shown that they have offsetted carbon through plantations. So they have planted certain trees, which is the carbon sink they have generated. And Mahindra is taking offset from that sink. Same with Tata Chemicals. They are saying that they have carbon capture facilities in UK. They have developed a carbon capture facility which captures the carbon, and they use that carbon within their manufacturing process. So that is something, absorption of carbon they are doing, but they are doing in certain different markets, certain different place, and it is not directly reduction or optimization. So hence it is offsetting opportunity. Similarly, Siemens has shown that they have bought certificates. There are certificates which they have shown, and they have bought these certificates from a company which is in Mexico, which is generating wind power, and they bought these certificates to reduce down their emission, which is again an offset strategy. They are buying something from outside to offset. So mainly offsetting is investment driven strategy. You invest and you don't make any broad changes. So this strategy is mainly applicable for banking, for example, service companies, because they are mostly operating out of, let's say, rental premises, and they have limitations in order to switch over to renewables because the place is owned by someone else. They can't install, they can't replace. So they usually go for offsetting strategies. Because they don't have a mechanism right now for reduction. So first you identify optimization, identify and cover up all the reduction, and then go for offset is what the whole decarbonization strategy is all about. Moving on to last two topics which I want to cover. I think we have half an hour, right? Aman, you can confirm. I mean, how much time we have in hand?
Yeah, Prakha, you can go.
The questions and
We have time.
Great. So with respect to the carbon credits, again, a new terminology, new concept, and an interesting concept as well. Let's deep dive into this, which is what do you mean by carbon credit first? As the name suggests, you have a credit, but it's the reverse way around. I mean, if you read the definition, even Aman also described the carbon credit as the start of the session, which is you have a permit to emit. It's kind of you have you bought something, you bought a permit that this much emission you can do in the environment because you have bought the permit, and you have bought that permit because someone else has not done the emission and captured the excess CO2 at some other location. So let's take an example. Let's take an example that I am an investor, I am a NGO today, or let's say I am a environmental enthusiast today, and I do a lot of plantations. I have acres of plantations within my control. I'm just taking an example. I'm not that rich for that. I have lands and I do plantations, by the way. But then I'm just taking an example that hypothetically I have, let's say, 10,000 acres of land, and I've done mangrove, or I've done trees on that land, and now I have a lot of bank of carbon capturing which is happening on that land, and which is not being utilized because I don't have a business. I'm not utilizing that. I'm not offsetting that. So it's an unoffsetted bulk of carbon positive or carbon positive impact which is held in that land. I will reach out to an agency. I will reach out to, let's say, Vera in this. Vera is a global agency which certifies such claims. So what I will do is I will go to a certifier auditor first of all. They will audit my claim. They will calculate everything, and then I will go to, with all these documentations, I will go to a third-party agency which is, let's say, market drivers. Let's say Vera, for example. India is also coming up with a regulator. They have not come up with it. We'll discuss that later. But let's say I go with Vera and I get this certified and convert it into a token. Now I have a token. So I have a token in hand that in the last year, I have positive carbon. I have captured carbon, let's say 10,000 tons of carbon I have captured. And hence I have 10,000 units of these certificates, because each of these certificates is 1 unit each. Now I go to the companies and whoever is generating the emission, I will ask them, you are doing the emission, I'm capturing the emission. Why don't you buy the credit from me? So that you have more power to do the emission, or you have a permit to do the emission and you can offset. So what the companies will do is they invest in my project. So eventually what I'm getting is more funding to build such more lands and harvest more such lands to capture more such emissions. So that I'm getting promoted to do good things today by this whole process. And that's where the concept of carbon credit is evolving a lot across the globe. You have upside, you have downside of any new theme, a new area. But the downside probably is that someone is passing their bad things on someone which is doing good. So companies today can get more motivated. They can play around with the money power and they can keep on emitting. and they will not realize the responsibility. That's the negative side of this whole story. But the positive side is someone which is doing good is getting paid back. He's getting promoted. He's getting motivated to do more such good things during this whole process. So once this credit is transferred, what will happen is there is again a portal. You can assume this as a blockchain or a token. So you get a token, and once you offset this in your books, let's say the company then disclosed in their reporting that they've offsetted this token. And so if you see the Siemens example, I'll just go back. They have given the number also here. What is the certificate? 22805 cancelled in FY21. So when they're offsetting, they're claiming what certificate they have cancelled. So they will go on the website and they will cancel that certificate back once they're offsetting. So now the same agency is also recording back the cancellation part. So it becomes the whole chain. So the new certificates get generated, it gets sold into the market. The consumer who is consuming will offset it. If he is doing a proper claim, a mature claim, he will give that number into the books and then say that it has been cancelled. And then the date of cancellation will be captured. Vera will again cross back that claim. And then the whole loop get completed. That's the whole market which has been set up already. Vera is a global agency. I mean, India doesn't have any such regulatory as of now as we speak. But there is already a process which is in progress, which is there is a law which is Carbon Credit Trading Scheme. There is a scheme which is being out by Energy Conservation Amendment Bill very recently in I guess last year, which was tabled in Parliament, and that has come up with a set of mechanism which will govern this whole market. So you'll see there's a steering committee, there's Apex committee, then there is a steering committee, and under that committee there are CERC rules which have been, and there would be a registry, there would be exchange which will get created under all these frameworks. And during this registry will ensure that the claims are being monitored, the claims are being offsetted on a proper basis, and then the exchange will trade those body. It is similar to social stock exchange today. If you see today, they have come up with a structure similar to that nature. You have an impact certificate generated, someone is validating the certificate, registry is being created, there is exchange, there is NSE, BSE on which you trade those certificates, and then once the certificate is consumed, you offset it, you struck that down, and then it get delisted. So that's the whole process which will be followed going forward in Indian market as well in terms of the overall process. So alongside CCTS, which is Carbon Credit Trading Scheme, government has also come with draft green credit programs, wherein they are not just emphasizing the carbon credit today, they are emphasizing other credits as well, like water credit, agriculture credit. So they are on the similar lines. What the government is trying to do is to push other initiatives also, not just social credit, let's say social stock exchange, which is again the type of similar set of market wherein they are pushing the social impacts, not just the environmental impact, but also the social impact. So government is trying to come up with such innovative ideas and extrapolating the carbon credit market, which has already been established worldwide, to get this done in a more mature manner in India as well. So that's under the pipeline right now as we speak. With respect to the carbon tax now, so this is what the carbon credit is all about. So to just summarize again, it's a token which is generated by the person who has done good, and it is bought by a person which is emitting the carbon into the market. He offsets. There's an agency third party which validates the whole process, whole flow. They have set up a blockchain kind of technology wherein they validate, they certify the whole claims, and then knock off the claims. That's the whole process which happens. So right from what we have done through this whole journey is we have understood what to calculate, what is carbon credit, what to calculate, how to calculate, what is the mechanism of GHG protocol, how do you identify the total amount of an emission which is being generated, how do you decarbonize, what is the decarbonization strategy, right from optimization, reduction, and offsetting. In offsetting, you can even buy carbon credits. And what do you mean by carbon? Now, the last part of the day, which is from my side, I think we have still 15 minutes to go. Quickly, I will cover the last part, which is carbon taxes. The last part, which is again an innovative area, which is setting its footprint right now. Recently, the news of CBAM, which is cross-border carbon border adjustment mechanism. EU has recently come up with a new set of tax in the EU market, and it's an import-based tax, similar to we deploy cess, let's say, on imports. We have deployed several sorts of levies and cess on our imports of goods, just to ensure that the goods are in equal, when they enter the Indian market, they are in equal financial structures, and no one gets a dumping advantage when the goods enters in the Indian market, so that indigenous market is flourished. Similarly, what US recognized, or EU during this whole process. So just to give you a perspective, European world is today is the most advanced. Europe is the most advanced countries today when you talk about carbon emissions. So they have done a lot of initiatives on renewables, and there are countries wherein they are operating almost 80, 90, 95% on renewable energy sources. So they generate a lot of less carbon today, and because of that, the pricing is on a higher side because all of these initiatives requires investments, right? So they've done those investment and they've taken that hit already in the economy. Now with CBAM, what they're trying to do is they're trying to gain. So what was happening is European companies or European markets, they're just simply importing the goods because they're getting cheaper imports from outside. And what was the factor which was not being accounted for is because let's say India is a high emitter, let's say China is a very high emitter, and they have not taken that amount of initiatives. Hence, their cost of goods is still lower as compared to Europe. So once the goods get imported in Europe, what Europe has come up is that they will say that they said that we will deploy a tax, we'll deploy a carbon border adjustment mechanism tax, wherein the differentiation of the carbon in the goods. Let's say when you are buying the goods from China, you have to, the exporter from China has to disclose how much scope 1, scope 2 emission that pertains to that goods. And that goods will be compared to the indigenous goods and the emission which is there exist in the indigenous goods, and the difference of carbon will get taxed. And that will be a demotivation for the companies to import less and consume more from the local market. That's what the whole strategy is all about, which has come up in the form of CBAM. Again, it's a new mechanism wherein they're taxing the carbon. But overall, globally, this is not something new which has happened. I mean, there are several companies which have domestic taxes already deployed on carbon calculations. They want to set up, they want to demotivate people from generating carbon. Even India has some amount of carbon taxes in bits and pieces. For example, today there is a compensation that says under GST, which is 400 per ton. Again, it might be updated. It's an old data. Probably I have 2017 for deployed, which is having which is a hit sort of on consuming the coal. So if you consume less coal, you will get less compensations as to be paid. So such taxes are there in the market, but not in the direct shape and form of a carbon tax. So there is no nationwide carbon taxation policy which has been come out yet, but it has been talked up on in various economies across the globe. And it becomes an opportunity for all of us in terms of getting ourselves ready. Even CBAM has given a big market. All the companies in India which is exporting in Europe today, especially in these 6 sectors, these are the 6 sectors they're targeted: cement, iron, steel, aluminum, fertilizers, electricity, hydrogen. These are the 6 areas which they've targeted. So any export which is happening to EU countries which are related to the 6 sectors, you can directly reach out to those companies, and they are right now facing the heat of calculating the CBAM or this border mechanism tax from their own, because they have to submit it to their importer, European importer, and they have to upload that in the portals in Europe to facilitate this whole calculation. So that's all about carbon tax methodology. One methodology which I discussed, the CBAM, which is there right now. So last slide from my end, which is conclusion. So first point, which is there is a clear need of transition and adoption. So I've given you an ample sort of examples, ample sort of need. Already I've described that there is a big need of companies, corporates to calculate all of these carbon emissions factors and all. There is a big need to go for decarbonization strategy. Overall, government is pushing. There's a government-wide push. There is a sector-wide push already out in the market, which requires companies to adopt all these practices. And there is a big gap with respect to the capabilities available in the market, and that gives us a large amount of opportunity to play around. So if you learn all of these on a fast-paced basis, you will be able to get yourself involved in these rounds of accounting and calculations right from the early stage. Which is the next point, which is bundle of new opportunities. As I started the slide, there were a lot of areas which are already there in place. There's a concept of carbon accounting. There's a concept of audit, big time. I mean, there are several companies today which are looking for auditors who can come and audit their emission claims. Even for CBAM now, what the importers are asking, and tomorrow even the government might put this as a mandate that the claim which you are making, which is of scope 1, scope 2, has to be audited. You can't send us a self-assessment data. You have to be audited by a third party and then send us. Today, I am working with several clients today wherein they have an export commitment, and the exporter has clearly put a mandate to them that please come out with a decarbonization strategy, please come out with a carbon policy. please come out with your calculation. Please let me know what is your net zero, because I have a net zero commitment. I don't want to work with you if you don't have a net zero. So there are a lot of opportunity with this, which is building up, mainly driven by stakeholders like customers, uh, regulators, investors. Investors also don't want to invest in the companies today which has high amount of carbon footprint. They want to first calculate, assess, and then only invest. So these stakeholders are putting a lot of pressures on the corporates, on the companies, both listed and non-listed. There are a lot of non-listed companies today, MSMEs for that matter, which are wanting these calculations to happen, but they don't have ample resources, ample understandings to do that calculation. Lastly, on disclosure perspective, there are a lot of already set disclosures like BRSR Principle 6 requires you to calculate emissions. GRI 305 requires you to calculate emissions. TCFD, there is a metrics and targets base which requires you to do calculation. Even IFRS S2, which is climate disclosure, required you to calculate the emission, report the emission, audit the emission. All that is already there, well established in these structures. So that's it from my end, team. Over to you both. Any questions you want to put it up, Ruchi?
Thanks, Prakhar. Thanks, Prakhar. I guess it was really a very interesting, engaging, and a comprehensive, detailed, session that you took. And I think a lot of questions were really answered, but we still have people asking a couple of things. One, there are some generic questions which I just like to clear to all the participants. This session is a recorded session and it will be played on the Institute channel, the YouTube channel, and will also be available on the Institute link on the website. Basically, the link will be available on the Institute website. So you guys can go and see it from there and you will get the presentation itself. So there'll be no separate emailers on the presentation is what I want to say. But it is available for you guys to go and check it out. Now I'll just take a couple of questions, and I think one, because I'm not going in terms of the order of receipt, I'm just going basis what I liked, and I thought that's something which can interest me also. So I guess the first one that I have here is how we can do accounting of VERs of carbon credit. I didn't see VER on your site, so I was a little curious about it.
So basically, that's it. I mean, as I said, in terms of these are you can treat it as a intangible tokens. So the way you treat intangibles today, because there's no advisories that is out. There's a guideline which is published by Institute long back. IC has also published a guideline, but it is very old in terms of the advisory. So there is a opportunity there as well to publish a new advisory how to account for all these tokens. Right now, you can treat them as intangibles currently because they have a market value attached to it till the time it is knocked off. So similar to you buying an asset and then knocking it off back as an asset is what you can buy and sell sort of, or adjustment against your financial numbers, you can show that. So how much money you have paid, you can directly expense it out if you're not holding it. If you're holding, let's say for a year and then next year you are knocking it off, then I mean you can hold that as an asset. Again, I'm not very good, to be very frank, on the proper accounting notion, but you can treat it as an expense and asset methodology.
So depending on the period of holding is what you're saying.
Yes.
Okay. So Aman, next question for you.
So, Prakhar, thank you for a wonderful session. So another question that we have here is that from where can these tokens be bought or sold? Is there a single platform, or are there multiple ways by which this can be?
So right now there are a lot of platforms. I would say there are multiple platforms which do the trading. You can even source them through your networks, channels. All today, I mean, large companies like Deloitte, KPMG, and others of the world globally, they also have their own exchanges built up. But India is still in the pace of coming up with a settled exchange. Right now, there is no settled, at least in Indian market concept, there is no settled exchange. There is not even sort of recognition as well in India in terms of these tokens, because right now there is no Indian agency which has been identified to recognize these tokens. So these are right now going on a global perspective only. They are globally, as I said, Vera, for example, is one of the company which do the certification of these tokens. Once you get the tokens, you can list it on your own homegrown exchange. There are multiple companies which are running the exchanges today. If there's a list required, I can share that separately. You can attach that in I will update in the slide, or I mean, I don't know how I can share that separately on the list. I've not covered that in the slide.
Okay.
Prakhar, the next question that we have is like, when normally greenhouse emission or carbons are talked about, there always used to be a talk about greenwashing, but your presentation didn't cover anything around greenwashing. So is greenwashing now replaced with carbon credits, the name, or how is that?
No,
What's the
so the whole mechanism, if you have seen, which is, let's say, if I follow a proper GHG protocol mechanism, and if you have seen the type of disclosure, I've shown few examples. Greenwashing usually happens when you don't, let's say, for example, I just write that I'm doing offsetting, and I don't give proper evidences of offsetting. The way you have seen Siemens said that they have give the name of the certificate, number of the certificate, and what they have struck out. That's differentiate from greenwashing to actual reporting. So if you properly follow the emission protocol, GHG protocol, this whole process is being set it up to ensure that the greenwashing doesn't happen. So greenwashing happens when you, like, for example, let's say solar offsetting, or let's say I have plants, I have plantation in place, and I'm doing offset. And what I'm doing is, instead of showing that offset separately, I'm just knocking it off, reducing my scope 1 2 emission, and I'm not showing my total footprint today. That accounts for an greenwashing. So if I don't follow the protocols properly, that you enters into the space of area of greenwashing. If you follow protocols properly, automatically you are ensuring that you are not doing any sort of greenwashing.
So, Prakhar, on the same lines, I had a question. Currently, in the Indian scenario, are there any sort of regulations around greenwashing, or is there any sort of audit or certification of carbon neutrality or the numbers that the companies are posting? And a follow-up to that would be, is what is the role that CAs are playing currently in this environment, or that something that you expect CAs to play in the future?
So, for example, government has already taken one initiative, which is getting rolled out the BRSR assurances. So this year, top 150 companies has to mandatory go for assurance. Emission is one of the assurance criteria in that. I mean, out of the 9 areas which will go for mandatory audit, assurance is one of the areas. Emission is one of the areas. So automatically, there is no rule or there is no law which is governing the green washing currently, but government has started taking initiatives in the form of mandatory assurances. So once the third party come on the board, they will validate your claims, and that's how globally is also happening. And that's the base. How do you differentiate between pitch and levels across the globe? That's the factor which government is across the globe are using. There are established practices. Even India has adopted certain certain audit procedures in India. ISA has already adopted certain audit procedures which help you to, which gives you detailed directives, guidelines on how to conduct an audit assurance in a more independent manner. So there are guidelines. There is a push already from the regulatory perspective. This year it is 150. Next year it is 250. Next year it is 500, and then eventually top 1,000 companies by 26-27 has to mandatorily do their audit of their emission numbers, which will cover everything: scope 1, scope 2, scope 3, offset, renewables, everything will come into the picture. So automatically the greenwashings from that perspective will go down.
Okay.
Prakhar, the question was that in the initial sections of the process, when you talked about boundaries to be defined by the organization. So how are these boundaries defined? So are they, done by the management, approved by the board of directors? A little bit light on that.
I think it's a very good question. So, see, first of all, definitely it is defined by the management overall, because they control the overall report. So board finally have to sign off the, let's say for the BRSR report, it goes to the board, it goes to the committee of the board, and they sign off the report. So they can take, at least management can start taking this initiative or action that they should define the boundaries from a more holistic basis, and also from a larger perspective. See, although BRSR has given a option today on standalone versus consolidated, but if it has to be comparable with your consolidation, eventually you have to publish a consolidated statement as well to showcase your profile better. Right now, these decisions are being driven mainly by company secretaries, because it's a compliance driven process. BRSR itself is a compliance driven process, but surprisingly, in certain companies, I've seen that BRSR is reported in standalone, but SR, which is sustainability report, which is driven by management, they are already being reported on consolidated. So even these type of gaps are also there. So it depends on from where it is originating and where it is ending. These things varies. But then if you are, as a consultant, if you are trying to reach out to your companies, you should push them for consolidated, because then that's how your financial versus non-financial numbers will vary. Today, you will be able to make the similar set of claims the way you are making the claims in annual reports on consolidated basis. You will be able to make the claims on consolidated basis and in the emission. Plus, you will be able to also cover the overall value chain. I mean, overall holding structure of the company. So to summarize, I mean, I think the answer lies with first of all the stakeholder you are talking, and also the stakeholder for which the report is being created. If it is only created for regulatories, companies usually try and only follow the minimum sort of standards. If it is followed for investors, if it is created for customers, companies will showcase best of their effort. So from that perspective, the things are still under variation. If it's a management-driven fund, if the management is already keen enough on taking initiatives, companies like Mahindra, companies like Tata, they are keen enough on taking initiatives. They are already reporting both on standalone. I mean, many companies are reporting on their standalone basis, and consolidated group reporting is also happening.
No, thanks. I guess that was really a nice and a detailed answer. And I think just we have a couple of questions, but I think just being cognizant of time, I would just like to end up the session and really thank you, Prakhar, for spending your whole 2 hours of intensive talking and discussion without taking really a break from the conversation. So thank you very much for it. And very, very engaging, because I think Aman and I am surely have learned a lot. We've been very attentive hearing you. And I think we could answer some of your questions in between. So, which means we've learned something. And I'm sure the participants would have also picked up a lot of the knowledge and information. So, so thank you for your time and your contribution. And I would really like to thank the Sustainability Board for organizing such, topics and such webinars, which are really engaging for all the chartered accountants, and they can really learn in terms of what are the possible future opportunities that can come up, and how we kind of just need to kind of extend our hat, as you mentioned at the start. So it's just extending our hat that we need to do to kind of take on more, responsibilities or more areas of focus for us. So thank you to all the participants for your engaging questions also. I hope we've been able to cover, Aman and I have done justice to kind of pick up all your questions. Thanks everybody. Back to SRSB.
Thank you, everyone.